Hey everyone, welcome back to another episode of AWM Insights. Justin Dyer here, Chief Investment Officer of AWM, joined as always by Mena, Hanna, Portfolio Manager here at AWM. And we're super excited to be here today. Lots of interesting things continue to go on in the world of markets, and we're going to kind of continue that conversation today. For many of you who've been listening over the last couple weeks, really since the start of the year, you'll definitely know that it's been an interesting year, and certainly you know that if you're paying attention to the headlines, and really kind of the bifurcation of the narratives. It seems like the economic data is weak, but then markets are doing okay, and specifically some companies are doing really, really well. Now, there's a lot of nuance and a lot of in between there, and so we're gonna jump right into that today. Mena, give us an overview. Like what are the big narratives, the big interesting stories, the interesting divergences that you're seeing?
Yeah, I think the biggest story and the most interesting one to me is the K-shaped economy. And this is sort of a newer term that I'm hearing, where if you think about a K, our economy is moving along. Some things are doing extremely well, some things are not. So
right, the top of the K is doing well, the bottom of the K is not.
It's fallen, yeah. And it's important to note that is very true in our economy, and we're seeing that in some of the raw numbers, but I think we're also seeing that just from a soft data side. In person, unemployment in some areas of the market is increasing, and other areas of the market, employment is really strong. If you look at employment holistically, we're at 4.3%, which is a pretty solid number in general. So you have this divergence between, in some ways, the haves and the have-nots, and that's reflecting in the economy in some ways, but markets and the economy are obviously not one and the same. So we still have all-time highs. We're reaching all-time highs on a daily basis sometimes, depending on the week. The Dow just eclipsed 50K and held that level for a couple days. S&P eclipsed 7,000. So you're getting these all-time highs, and you're breaking some of these new figures, digits that people kind of never saw coming. 50K on the Dow, but you're doing that in the face of some areas of the market and some people especially that are struggling.
Yeah, and I think there's a couple really important, really essentially punchlines in there, right? Well, one, you said explicitly, that is, the market is not the economy is not the market. You can talk to folks out there and maybe it's a political conversation and people are feeling one way or the other, and then, hey, what's going on with the markets, right? Maybe you're on one side of that equation right now. Maybe you're on the other side of that equation when someone you don't like or do like is in office, and you really have to separate those two things, right? Both who's in office and the markets, who's in office and the economy, and then the economy and the markets. They are two distinct systems, let's call it, right? The economy and generally the data you're talking about and seeing is very much backward looking. Markets are very much forward looking, right? Looking into the short to medium term usually, but obviously we're thinking about investing very much for the long term and getting rewarded for that. And then there's an element of predicting the future here, right? There's and how difficult that is, right? What you just expressed and described is an incredibly nuanced system or sequence of events that is going on. Tell me anyone 2 months ago or 6 months ago, whatever, pick your period of time, who would have said, hey, we're going to be in this period right now, and this is how markets are going to react. Yeah, maybe there's that one oddball out there that did. I would argue that it's probably more luck than actually being smart and skillful in that prediction, because that's how it has always been across time. But it's just a great reminder how nuanced markets are, how much information they're taking in, and how markets potentially react to certain items. Can be very contradictory at times, where you would think that it's a negative data point and markets react positively, or vice versa. And the other thing I would say is like a kind of the takeaway punchline for this is certainly this year, and I would argue even 2025, diversification has proven its worth once again. And I say that kind of tongue in cheek because it's like, it is that one free lunch that we all have. And so often people, just fail to appreciate it or get caught up in whatever the theme of the moment is and think, oh, I don't need to be diversified. I can make money. I can make more money by being overly concentrated or making a bet. And hey, that is exactly what it is. You're starting to skew towards gambling as opposed to very disciplined approach to investing over the long term, where you get to compound your wealth year over year over year over year. And that is the power of diversification. It helps you compound wealth in a better, more predictable way.
Yeah, and especially something that I feel like we see a lot, and we advise against it, but is concentration. And I have a lot of friends that concentrate in individual names, Microsoft, Apple, have your pick of the litter. This year has been a great year so far. And yeah, we're only like 6 weeks in to show you that that's probably not the best thing to do. Microsoft is down close to 30% from its all-time high, which is that's pretty wild for a company that had, a $4 trillion plus market cap to lose more than $1 trillion in 3 months. That's a big number. $1 trillion is a lot of money. So, and that's like a company that I hear a lot of people being like, Microsoft is the future, AI, hardware, services, all of these things kind of bundled up together, kind of a no-brainer, down 30%. Like, that is a serious sell-off. Apple down 5%. If you look at the other side of the market, the value side has actually performed extremely well this year, especially. Like the value premium, I'm going to pull up the statistic right now, but looking at the value premium, if I'll throw it actually up on here, just looking at the last 3 months, the small value premium has done extremely well. You can see large growth here, which represents a lot of the big names, Apple, Microsoft. That part of the market's down 4.17% in the last 3 months. Small value's up 15.57%. And you can see all of the other points. The premiums are actually working with us now. If you actually push out, I'll show the 5-year figure as well. Value's done extremely well. So that's why we diversify. We do still hold, and all of our clients hold, a pretty similar market-like exposure, market weighting exposure, maybe slightly less to these large growth names. But we do concentrate more towards small value because that's where we've seen the excess return historically over the last 100 years. And yeah, over the last 5 years, you're definitely seeing that play out. So we're benefiting from it.
Yeah. And I always like to say it's systematically applying a Warren Buffett type approach to investing, right? That value investing, amongst a lot of other things that we do, right? It's not, you probably hear us say small value, these factors and whatnot. There's a lot of other approaches that we're really trying to apply to seek out performance, right? When we talk about diversification and that being your free lunch and this and that, don't time markets, we're not sitting here saying we're not trying to outperform. We are, that is a goal of ours within a client's priorities, right? That is the number one benchmark that we are seeking to accomplish, right? Making sure clients can meet their priorities in the highest probable fashion. But we are trying to outperform along the way within various asset classes. But we're doing it in a data-driven, systematic, really, really well-researched sort of way that takes into account taxes, takes into account the strength of data and how markets behave. And yeah, sometimes you have to wait for markets to behave, quote unquote, properly. And in a way, we're kind of seeing that a little bit right now. There's a little bit of a right sizing. I'm not going to go so far as to say, hey, markets are now a lot more rational. There still is plenty of irrationality that is happening and always does happen. But there is kind of a rebalancing going on, whether it's between U.S. and international emerging markets or value growth, small versus large, et cetera, et cetera.
Yeah, we talked about it kind of on the sports podcast, but valuations and multiples can only go so far. So if you get a crazy run up in the large growth side of the market, it is only a matter of time before one of two things happens. And this is getting a little bit crystal ball-y, but you either have small value catch up or you have large growth sell off. And yeah, we've seen that this year in a pretty substantial fashion. Like that's a almost 20% deviation in performance over a 3-month period of time. Like that is, you annualize that figure and that is pretty crazy over the 1 year. And I'll throw that up right here, but 2.98% for large growth, 15.94% for small value. So yeah, this has been a good time to have exposure to those rewarded factor tilts.
Yeah, and bringing this back to what we talked about at the outset, right? There's a lot going on in the markets. We're highlighting some of the, I guess, more intricate data points and the nuances between larger companies and small companies. But going back to comments around the economy versus the market, right? It's just a good time to remember that those two things in headlines and the people you're talking to or your friends of a friend or family members, extended family members, they could be feeling a certain way and markets could be reacting a completely opposite way. And that is just the nature of investing. Now, I will say, hey, take that with measured, I guess, appreciation. Appreciation is a good word. Where, right it's always good to prepare for potential. And I'm saying this more emotionally than anything. Prepare for potential pullback. We've seen quite a bit of volatility. We've even talked about it on Insights recently, where volatility, meaning markets going down specifically, like that's the one that actually hurts. That it makes you uncomfortable. And could the current economy lead to that? Sure. Is it a foregone conclusion? Absolutely not. But at least having that mental preparedness is always a good thing, and knowing that there's a plan in place ahead of time, right? We certainly talked about that a decent amount last year, I think, on this podcast, where there's a plan in place really for an all-weather, all-season type approach to markets to take advantage when you can on the positive side of things, but also the negative side of things.
Yeah, and to double down on one thing that you said, just in terms of kind of as people gauge markets and as people gauge the economy, a lot of times that comes from your own social circle. You're asking your friends, how are you doing? How's your job? If they're looking to change jobs, how easy is that? We're looking at these extremely small data sets and potentially making assumptions that we know what's going on in the greater economy based on what our social circles look like. And that's an extremely small data set. It's also important to know that, like, even if you look at the macro side and you look at consumer confidence, which should be a representative statistic, like that doesn't always line up. Consumer confidence has been at near an all-time low. If you also look at, we were just talking about this, but car repos, like people have been getting their cars repossessed at an incredible clip recently. You'd think all of these things would lead to a soft economy. Maybe people are buying less iPhones because iPhones are now super expensive and they're typically a discretionary purchase. And I'll take it a step further. Like, I don't think the latest iPhone is that great. So all of these things together might make you think, well, Apple's not going to do well. Apple's not going to sell a lot of iPhones. Stock price of Apple's going to go down. We just saw Apple have the best quarter in terms of selling iPhones that they've ever had. So there's a lot of these, call it data points that we perceive, but they can't be acted on, like you said, because it is there's such a gap between how the economy is doing, what you actually see, the biases that are also included in what we see and what we perceive as humans and as investors, and what actually happens with the stock price of something, which is completely different.
Yeah, totally. I mean, you can even add to the Apple story, their lack of investment in AI, right? They're investing a fraction of what these other companies are yet. And people have been scratching their heads, but they had a record quarter. It really is a fascinating world we live in right now. And we haven't even got into how AI could be potentially impacting some of the economic data. I mean, that's like a whole nother conversation, which maybe we'll get into at a later date. Well, yeah, a little bit of a kind of roundabout rambling episode, but the core takeaways here: economy is not the market on either side of that. Good economy, bad market. Weak economy, really good market, or at least a market that's hitting all-time highs. It's still early to tell what this year will actually produce for us. But yeah, just a reminder: it's hard to discern anecdotal economic points from your social circle, even distill what's going on between consumer confidence and then what's going on with iPhones, right? These systems are incredibly complex, and paying attention to them, number one, is super important. Having an opinion is completely fine, but then knowing how and when to act on that opinion, which the answer is very, 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 very rarely, is the most important piece to the long-term puzzle. Hopefully that was helpful. We will certainly cover any and all topics that you guys throw our way. Mena will send his shout out his phone number, excuse me.
Yeah, 626-862-0355.
Yeah, and we're always looking to topics and or questions you guys might have. And until next time, we'll wrap there. Own your wealth, make an impact, and always be a pro. Thanks for listening.